I started in the business personal property unit as a clerk, and went through the level 1 and level 2 certification classes, earned a position as an appraiser, and received my personal property specialist designation in 2017, which extended to me the AZIAAO's level 3 appraiser. So I guess that kind of makes me a specialist. When I was asked to do a presentation on personal property, Quanta asked me to kind of keep it general. So I thought to myself, what is a general approach to personal property? Maricopa County is currently going through a process of blending and cross-training our real property appraisers in all the aspects of the property. We're also, personal property hasn't quite been blended into that yet. We've been told that we will eventually. So I thought what better time and what better way to do a presentation would be to kind of compare the two so that it kind of more of an awareness and awakening, a presentation of what personal property is and how it's a little bit different. You can go ahead and put to the
Okay, sorry.
I don't know how to signal yet. And I thought, how do we start? So keeping it basic, we'll start with just property basics. Property in general it's something that is owned by a person or a business. It's a thing or things that can be owned. Property owners, they have their rights. The right to possess their equipment, their property, to control it, to exclude people from accessing it, to enjoy it, dispose, are general basic public rights. Property has value. It can be valuable in its use, in its exchange, and that value is taxable. Valuation is calculated through either the cost market or income approaches. So essentially, property is property. But there are different property types. So we have realty. Realty, we're all aware of, is essentially property consisting of land and improvements. And then there's personal property, which by almost any definition in any publication that you read is anything that is not realty. That's kind of vague. In personal property, we have tangible personal property, which would be physical objects, the tables and the chairs that we're sitting in, and intangible properties. You're clicking a little faster than I'm prepared for.
My bad.
So the intangible being the non-physical items that do have ownership rights, copyrights, patents. They can be owned, but they don't really have any substance. You can't. You can hold the paper that's printed on, but so personal property and real property is actually pretty interactive. Personal property and real property are more closely related than most people would realize in the respect that they feed off of each other. And it's something that you don't really think about very often. It's kind of like, why is the sky blue? You don't want to think about it. But when there's real property expansion, such as a housing development, those of you from outside of Maricopa County may or may not be familiar with a housing development called Anthem, which is up north on I-17, just north of Phoenix. That is a Del Webb community. It's unincorporated land. They don't have a government structure. It's just a housing development. It's a pretty good little landmass, but it was just a housing development. As that development developed, and more people moved into it, the more people you have, the more services are required. So you end up with business expansion. So, go ahead. Mm-hmm. With more housing is more need of services. And if you go ahead, yep. With more population, the businesses have a larger workforce available. And they also know that people have money and you want to profit off that money. So you're going to provide more services to increase your income. It also works in the reverse, where when more business if a business chooses to move into an area, they don't always only hire the local talent, they sometimes bring in outside talent. Think of Boeing. Boeing isn't just necessarily going to hire only local graduates. They're going to bring talent from out of state, out of country, in to do some of their engineering work. And when you bring bodies in, they need houses. So personal property and real property is very interactive. The more you develop, the more your property base is going to expand in both real and personal property. So, did we get a clicker?
No. We gotta.
Our apologies.
So, before I get into this one, with property essentially being what it is, it's just property. It's something that's owned, something that the owner has rights to. It's something that has value. It's something that's taxed. And just because there's personal and real property, kind of what's the difference between it? If you really boil it down to it, it really kind of does boil down to location, location, location. It's one of the biggest things for real property, talking location, 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 because of like a corner property versus a property in a cul-de-sac. Well, real property essentially doesn't move. It's always going to be real property. But personal property is portable, but it does have the ability to be affixed to real property. So it's. Is that one going?
We might have a savior.
Thank you, Jim.
I can slow down.
Oh, sorry.
I was like, I'm trying to keep up with everybody clicking. I was going to throw little things in between. Okay, so. With the personal property and real property, portable versus stationary. Real property, when you think about it, and this is going to be a perspective overview of real property, there's a lot of intricacies into the administration and the application of how both real property and personal property are handled, but I'm trying to keep this general, and I kind of go by off of a philosophy and through life that perception is reality. Kind of like how the legislators perceived a situation and they decided we need to pass a law on this. Well, perception needs to be changed and or reviewed by introduction of outside views. So when real property is established, the data is kind of readily available. I kind of expected a few moans and groans off of this, but there are a number of regulatory authorities that our offices receive information from. When a sale is done, a deed is recorded. And I'm not sure of the current process here in Maricopa County, but I understand in the past that we regularly get data feeds back and forth from the recorder's office regarding new deeds, ownership changes, so that our system can be updated. When a property is purchased and is chosen to be developed, that development requires permits. So the permits identify to us that there's going to be new construction. Once you establish a record for a real property, the parcel and the improvement, and it's in the system, essentially there's low maintenance on that property. And we do have to review the properties over so many, it could be a 3-year period or a 5-year period, but not every single property is going to be reviewed annually. Once a house is built, it probably is going to take several years before somebody does something to change it where they need to take a permit and make a modification. So once property records are established, the system annually calculates the depreciation. If a change is done, the permit's going to be taken out, and we're going to be notified of those improvements. Field checks and/or desktop reviews will aid in validating those adjustments on that real property. But honestly, think about all the property. We have 1 million plus parcels in Maricopa County, and 1 million plus parcels are not going to have a permit every single year. The current valuation cycle for real property is 2 years. And I know that there's been an effort to try to bring this down to a single year. I'm not sure if that's still in play. No? And the appeal season is essentially 1 year prior to the tax year. I might need to be corrected on that, but once the valuation notices go out, the owner of the real property has their 30-day period to file an appeal, but it's at the beginning of the year, tax bill's at the end of the year. Personal property, on the other hand, is a self-reporting system. Arizona does not have a regulatory authority that says we have to record every single transaction that a business does. So we don't have a record of every piece of equipment that is acquired by a business or sold by a business. Our system is very high maintenance annually, where an annual mailing is done for the personal property statements to all businesses that are on record at the assessor's office. Obviously, we can't mail something to somebody that we don't know exists. Hence the self-reporting system. All of those annual property statements need to be reviewed for changes in its costs and/or ownership and/or address changes. Again, remember, personal property is very portable. I recently had a phone call from an individual, a CPA, who received a letter from one of his clients. He handles multiple businesses, and he was curious as to why his client was being asked about personal property and wanted to know when this started, this new tax that we have imposed on them. The CPA had been in business for, I believe he said about 23 years, and handles multiple businesses. He told me that he's going to find it hard to come to his clients and say, hey, guess what, there's a new thing you got to do. Turned out, the individual was also a member of the Arizona Board of Tax Appeal. Now granted, the Arizona Board of Tax Appeal does not handle property tax, they handle transaction privilege tax, use tax, excise tax. They don't deal with property tax. So another reason why this is kind of a good presentation, because if you don't know it, you need to be introduced to it. Our valuation cycle is a single year. We literally have to value all the property within this year before this year's tax bills go out. Our processing season is essentially April 1st through July 7th. Not a big window of opportunity to process. Our appeal season is current tax year. Now, our evaluation notices go out for business personal property I've seen them go out at the end of July, I've seen them go out in the beginning of August. It just kind of depends on what kind of complications we have that particular year, but they do normally have to be mailed out on or before August 25th. In real property, you have your basic categories. You have your land, agricultural, residential, and commercial. This is going to be a blended effort here in Maricopa County, and I'm sure a lot of the smaller counties probably already have this pretty well covered with one or two appraisers handling just about almost anything within their county. Personal property also has categories. Personal property in general, remember, is anything that is not real. So within personal property, we have business personal property. This would be the business equipment operated by, well, obviously operated by businesses. Within business personal property, we also have agricultural accounts. We have general commercial, which consists of retail, distribution, office, service companies, and leasing companies. Just like you would have different commercial buildings, we have different commercial accounts. We also have manufacturing, which I believe in our commercial unit would be considered major industrial. I can't see the laptop. We also have special properties, which consist of our foreign trade zone locations, as well as nursing home, childcare, mobile home parks. These are the items, these are the businesses that fall outside of the standard legislative class 1 and into the special, they receive different assessment rates. Now, personal property, again, being anything that isn't realty, everybody's aware that you can live inside personal property. Mobile homes are on the within the realm of personal property because of their portability. The mobile homes are titled with the motor vehicle department, but there is no registration like a tag for a car. Tags on a car are the personal property tax on that car. It's just in lieu of it being reported to us. It is reported and depreciated by the MVD. So in mobile homes, they're unsecured, and if a mobile home owner chooses to surrender their title to the MVD, where they are telling the MVD, I am no longer going to move this property, they can affix that mobile home to a plot of land, and where that can then be valued as an improvement on that property. Can a business operate within a personal property? We have IPR accounts. IPR accounts are valued as the real estate, but they cannot be valued on the parcel because the parcel land is owned by a government agency. The businesses, and again, I know we have several people from out of Maricopa County. Desert Ridge Marketplace, I believe is what it's considered, is a very large, kind of an outdoor mall. A lot of businesses up there, but it is IPR. It is government-owned land with a land lease for the businesses to build their improvements. The improvements are owned by the business, and that value is done through real property means, but that value is placed on a personal property account. Because it is a commercial business and it is a value, it is considered personal property by statute, the equipment under commercial category receives the benefit of the statutory exemption, which I kind of call a quasi-exemption. It's technically a split assessment rate. I wish they would change the legislative name on that, but that's just me. So, I wasn't going to get into major detail of how personal property is processed, but I just wanted to do a general overview of our season, essentially. All value in all property has a season. And it really boils down to the mission of an assessor's office, to discover, to list, to value, and defend the property. The discovery process for real property is obviously different than the discovery process for personal property, but the rest is fairly close. Within our discovery, we do an annual canvass, or at least we try to do an annual canvass. At the beginning of the year, forms are mailed out to the businesses that we have on record, and those forms are statutorily due back to the assessor's office by April 1st every year. Our office has the statute for this also allows for a business to request up to a 30-day extension. Now, our office has, for at least the past decade, has mailed the forms at the first business week of January. The statute for us to send forms is on or before February 1st. Our effort in attempting to get the forms out early was in hopes that the businesses would be able to complete them and get them to us without having to file extensions. But quite honestly, April 1st deadline, what else happens in April?
Taxes.
IRS, yes. Who's doing the IRS filings for a business? Their CPAs. Their CPAs are doing their personal property filing. Which one's going to take priority for the business?
Income tax.
So guess what? We end up with a lot of requests for extensions. The appraisers must complete the processing of all the returns, and my office's deadline is typically July 7th. Deadlines aren't set just to be mean. They're set because certain other things have to happen after the fact. And one of the things that has to be done is a variance review for personal property, just like variance review for real property. But since we are single season, we have a condensed time period that we are allowed to review our accounts. Variance is important to make sure that there aren't any typos and to see if what the major trend is. Another little backstory on personal property is that because it is a single tax year and some of the other things that happen after we close our roll is on the third Monday in August, the statute states, or I believe there's a statute that states the tax rate is established on the third Monday in August. Now, we don't determine tax rates, the treasurer doesn't determine tax rates. Tax rates are determined through the available value and the budget requirements of the operating districts. So, at the beginning of the year, what happens is an abstract is submitted to the operating districts to let them know what value is available so they can help determine their budget, and then the county finance can help to determine what the tax rate will be based on the value. Because we are a single year and our valuations aren't done until end of July, in February, an abstract is done on personal property as an estimate of what our value might be. So it gets really complicated when an abstract is done based on the current cost from last year, what it would depreciate, and then a business undergoes a major change. So because personal property does not have a Rule A or Rule B, we do not have a separate calculation to determine a limited property value. Full cash value is synonymous with limited property. We are not limited like real property on a 5% adjustment in limited property where the tax bill is based on. Major changes in a business affect major changes in full cash value. So the variance review is very important to validate why something has changed, especially for the tax districts. So in the defense, I'm sure this is pretty much standard issue. Valuation notices are mailed. Again, real property is mailed at the beginning of the year. Personal property is mailed on or before August 25th. Actually, I believe August 25th is the statutory date that the assessor's office has to send value to the treasurer's office to do the calculation of the tax bill. But we definitely have to have a valuation notice out on or before August 25th. The property owners have a 30-day period for them to appeal. They can review it for 30 days. They typically wait until the 30th day to submit their appeal, just like they do in real property. The appraisers have their 20-day response time. And again, if the owner disputes the assessor's decision, they have a 20-day period to file with the State Board of Equalization so that the SBOE can schedule their hearings. SBOE is required by statute to hear and decide on all cases before December 1st. So that in a nutshell is the essence of a personal property season. It's pretty compact, it's pretty hectic, and it's definitely a challenge. Anybody who's gone through any of the different courses from IAAO, like the 300 course, the 400 course, the 500 course, they all start with a basic introduction, the 500 class, the 300 class, the 400 class. And every single one of those classes has at least one little section in there where they talk about staffing requirements. How do you determine how much time you have to do something? How many personnel do you have enough personnel? So I thought I'd cover that a little bit. Currently in Maricopa County, we have 66,581 business personal property accounts. Doesn't sound like a lot when you compare it to 1 million parcels. But remember, we have a condensed filing season. The exemption, which has essentially eliminated 18,490 of those accounts, leaving us with 48,091 left to process for our season. And our season hasn't really started. I mean, their filing season has started. They have the forms. We're waiting for them to come in. There's a small trickle. But after April 1st, when the floodgates open, we got a few to work. Our processing season is essentially 14 weeks. When you look at April 1st to approximately the first week of July, it's only a 14-week period, which if you kind of average it out to only 4 work days, because some people have flexes, there's a couple holidays in there, and sick days, it averages out to about 56 work days, approximately. So the accounts to complete within the available time, per week we would need to process 3,435, or 858, and almost a little over a quarter or 3/4 daily. So currently what we have is, we have 2 analytic appraisers and 3 field appraisers. We've had a few retirements this year at the end of the year, so we're kind of short. So when you look at a staff of 5, in essence, we're looking at a weekly, daily, for an individual of those 5, they would need to at least process 687 in a week, or 171 and 3/4 per day. That's kind of like having your supervisor tell you to go out and do a square mile of parcels in a day and do all the work, the full workup on all of them in the day. It's a little uncomfortable, but
His favorite Christina. She must come here from
Just love it out.
now you might wonder, what kind of value do we bring in? In 2017, we had a grand total cost base of $56,303,925,485 in acquisition costs. After you depreciate that, it boils down to a simple full cash of only $10,536,911,053 in full cash value. But wait, there's that exemption. It only removed $816,542,955. But that one legislator wants to change that to $2 million, right? So it's going to be interesting. A little bit more detail on that statute that wanted to exempt the $2 million. It was, as it was stated, it exempts for those items starting in 2019. So typically how that works is, it will apply to new acquisitions, but all their old equipment is still under the old system. At least that's how the legislation was written in the past. I don't know if they modified the changes in anything to the current. So not only would the businesses still need to report, but we would still have to value all their old stuff in the old way, and then figure out how to administer that the new stuff is totally exempt. So just a little bit of logistics nightmare. So after we remove that exemption, it only leaves a taxable full cash value to be assessed of 9.7 billion. And if we apply the simple straight 18% assessment rate, excluding any oh, I'm sorry, I forgot. This is just business personal property. This does not incorporate any of the mobile homes or any of the IAAO accounts. This is just the businesses. They're the equipment that they operate. So if we only applied the 18% assessment rate, we're looking at only a 1.7 billion in assessed value. So it's a little bit of work in a short amount of time, but it kind of pays off in the long run. That's kind of where I'm going to leave off. I'm gonna cut it off at that, man. It's shocking all.
Back to work.
I guess I'll open it up to questions. Mr. Simpson in the back has a question.
How many designees in the state have a PP?
How many personal property specialist designees does this thing have? You know, to the best of my knowledge, I believe it has one.
You the man.
How many appeals do you get a year?
We get, actually this last year, I think we only had 300 or less. It really depends on how well we get our work done. If our value is good, our value is good. Most of the appeals that we get, outside of the one I mentioned that they wanted to be taxed, typically are due to the business error. They failed to record something correctly before their filing, and afterward they caught their error and they wanted to fix it, but they didn't notify us in time before we closed the roll. We have, there's a number of different reasons for appeals, but it's, with our variance review, we usually catch our typos now a lot easier. Yes?
How punitive is it, Duane, when it comes to
How
fines?
punitive?
How punitive is it? Is it pretty strict, you guys?
Well, the filing statute requires that if they fail to file within the April 1st deadline, and or if they got the extension, if they were past the up to 30-day extension by May 1st, the statutes, I believe, actually say the assessor shall apply a 10% filing penalty. So we can penalize the accounts that either file incorrectly or file late. Our audit unit, there are statutes that deal with auditing of business personal property, and our audit unit in the past has applied time value of money based on the fact that prior years were filed incorrectly. I've got a couple businesses on my desk currently that electronically filed with me this year, and in working their asset listing, I noticed that a lot of their older assets had just vanished. So in corresponding back with them to find out if they've had a major, are they doing a major downsizing? Did they forget that fully depreciated items that IRS say have a zero book value are still taxable? I didn't want to have to go through an appeal process and find out that they forgot something. So I gave them the opportunity to review before having to penalize them later on in an audit or something. But yeah, we have a little bit of teeth.
Got it?
Anybody else? Oh.
And what is the lowest depreciated value that you baseline out of all
Equipment does not depreciate to absolute zero. The minimal value on equipment, standard regular commercial equipment is 2.5% of its base cost. When you get into some of the other, classes, it gets down to 20% versus the 2.5%. And it's kind of unfortunate for those special assessments that the businesses, the standard commercial businesses, have pushed for so many different changes in tax breaks that the minimal value on business personal property used to be, I believe, 10%. It has been shifted down, and there's additional depreciation tax breaks for equipment that's within the first 5 years of its operation, as long as it's not exceeding the economic life, where the first year of depreciation gets an additional only 25% to the good. So when you take a brand new office full of furniture, all the furniture, 10-year life, using a hypothetical straight line 10-year depreciation, 10% per year, the first year depreciation would retain 90% of its value. Well, of that 90%, we, with the additional tax break, only retain 25% of the 90%. So it gets a big break the first year. That legislation was designed to draw more business into Arizona, where new businesses would get a break in their startup cost in regards to what their tax liability is. But it's what I call a funny animal, because in the second year that depreciation takes effect on a long life item, they tend to see their value go up. It's still with the tax break, it's still below what normal depreciation would have been, but because the break changes by 16% each year, the 10% drop, 16% climb in the tax break, it looks like a 6% increase in value.
That was the one thing that I found interesting on, they call it accelerated, but it really is additional depreciation, that it takes that initial dip immediately, and it takes that 5 years to climb back to the original depreciation line.
Right. It is designed to give them a break, give them a kind of allow them to establish themselves before they really hit the regular stream of being taxed. But it's not just for new businesses, it's for all new acquisitions. So even long-standing businesses get that tax break. It's just on the new acquisitions. So it drives accountants nuts. I like it.
There's a certain class, Duane?
Yes.
Only a certain class that qualifies for that additional depreciation?
Yes. Legislative class 1 commercial businesses and class 2.P agricultural businesses get that additional depreciation. When you start looking at some of the other special assessments, like the foreign trade zones, enterprise zones are gone. No more statute for enterprise, but foreign trade zones, their tax break is a 5% assessment rate versus the what used to be 25 for commercial, which is now down to 18.
Thank you so much, Duane. Let's give Duane a round of applause. Candy,
Oh yes, the tape measure.
tape measurer,
All right.
Yes.
this for you. All right, thank you. All right, thank you guys.